Good afternoon, everybody. Welcome to October. It has been quite a ride getting here. I hope everybody's doing well. Welcome to my webinar. On your screen, you will see a PowerPoint presentation in the center of your screen, like right there. This should take up most of your screen. There should also be a small box on the bottom right-hand side of the screen, down there, with the video feed. It has the presenter, me. On the left side of your menu, please select the questions and answers icon and type all of your questions there, which will be addressed at the end of the webinar. CCIOA credits are automatically generated once the webinar hosting site provides an attendance confirmation report that will be sent via email within 48 hours of the webinar. These credits are not transferable. They're for you personally, and nobody else. Please email education@altitude.law or call Sean directly at 303-991-2076 if you have any questions about receiving your CCIOA certificates. So with that being said, we can start. Hi, everybody. My name is David Firmin. I'm an attorney with Altitude Community Law. I'm in the transaction department, and I hope everybody's doing well. Today's presentation is on creative financing, or how associations ended up in distressful financial situations. As a general statement, I'm not providing legal advice. Please ask your association's attorney if you have any specific questions regarding anything in this presentation, because again, I'm speaking very generally, is overarching concepts as opposed to what is in specific documents. So those documents are going to have to be inspected and reviewed in order to get accurate information on some of these topics. So with all that being said, we can move on. To start with, it takes some reminding that a board has a fiduciary duty to the association as a whole. And part of that fiduciary duty, or part of it, is the duty of care, which means the board must act in good faith, prudently, and in the best interest of the association. And I say the best interest of the association, it's not their own best interest. It's not personal best interest, or it's not the best interest of their best friends, or best interest of the individual owners in the community. This also means they have an obligation for financial prudence. They must act in accordance with both the governing documents, with the stated purpose of the governing documents, the stated purposes of the Colorado Common Interest Ownership Act, along with adhering to their obligations that are set forth, like I said, both in law and in the governing documents. You should, at all points in time, make sure that you are documenting your compliance with this. So you say, how do you document it? Well, you document it through understanding and knowing what's in your governing documents, what the association is obligated to maintain, what the owners are obligated to maintain, what the association is obligated to ensure, what the individual owners are obligated to ensure. You need to make sure that during your homeowner education that you're supposed to do annually, you're making sure the owners understand these concepts as well, not just the board, but understand that the owners know what they're required to do, know what the owner's long-term obligations are. This should be in your meeting minutes, both in your board meeting minutes and your annual meeting minutes. It should be in your reserve study, that you have one, and that way you can understand what the association's obligations financially are, because everything is going to be set forth in that reserve study. You should also state why you are or are not adhering to certain standards. And when I say adhering to certain standards, we'll discuss that in just a minute. But why are you not 100% fully financed in your reserve study? Make sure that you understand that, and make sure you document it as to why you may or may not be raising assessments at a certain level or a certain clip. So how does an association end up in a financial crisis? Well, it's easy. They don't increase assessments over a number of years. I understand that one of the proudest moments of many boards is when they come out and they say, to their owners, we were able to hold the budget steady, and we have not increased assessments this year again and again and again, where you might not get assessment increases for a number of years. Well, has the cost of living gone down? The answer is no. Has the cost of water gone down? No. Has the cost of insurance gone down? No. So by definition, if you are not raising assessments to meet those increases in costs, it means you're saving money or trimming the budget in other places. Deferred maintenance is another huge topic. You're kicking the can down the road. Can you get another year out of that roof? Can you get another year out of the paint? Yeah, maybe you can, maybe you can't. But then all of a sudden, if you're spending that money someplace else, when those roofs can no longer be deferred, those roofs can no longer wait, you need to make sure you have the money to make those repairs. Unexpected repairs. Again, something I missed. Something, accident happened and it's not insured. So you have unexpected repairs and all of a sudden they take the money that you were saving for another project and they move it over to that project. Water line breaks are common, where you have to go in and replace a water line break and it creates a sinkhole. So you've got a massive loss that probably is uninsured, and you want to make sure that you have sufficient funds available to make that repair. And if they're coming out of your reserve account, it makes it very hard. Inadequate reserves. If you have a reserve study that's either older, outdated, because anything past about 5 years is impossible to predict because nobody knows exactly where the markets are going and where costs are going. If you don't have sufficient reserves, it makes it hard to address these long-term capital projects. If you don't have a reserve study, I could make an argument that not having a reserve study is a breach of your fiduciary duty to start. Because if you don't have a reserve study, how do you plan for the future? How are you able to identify those particular things that are going to need to be repaired in the future and when they're coming up and potentially how much they're going to cost, particularly how long is their anticipated life? You know how long an anticipated life is. That is actually ascertainable. And if you're on the front range, your insurance deductible. As I'm sure everybody on this webinar knows, that insurance deductibles have skyrocketed. They are now going to a 3 to 5% wind and hail deductible, and a deductible of $300 to $500 to $800,000 is not uncommon. Do you have that money sitting in an account to pay a deductible after a hailstorm? Okay. We'll address a few questions real quick, or a few conversations. Is there supposed to be audio? Yes, there is supposed to be audio. Can you not hear? The microphone is on. Please let me know if you can't hear me. So, moving on. Since nobody has said they can't hear me. All right, increases in assessments. What does the law say? Well, the Colorado Common Interest Ownership Act states that you are on an annual basis required to budget to your anticipated cash requirements plus reserves on an annual basis. That is the baseline budgeting requirement for an association. That is for post-Kiowa. That particular piece applies to pre-Kiowa too. You are required, as I mentioned, to budget towards your anticipated expenditures for the year plus reserves. There is no cap contained in the Colorado Common Interest Ownership Act or the Colorado Revised Nonprofit Corporation Act on percentage of assessment increases. Now, I do know that in certain situations, I'll say that really quick again, certain situations, there may be caps for specific types of units in certain communities. I know that in some communities that have an affordable or a deed-restricted housing type concept, there may be caps on how much you can increase assessments each year. But again, that's going to be very document specific. That's not contained in the statute. The statute merely states that you're required to budget to your anticipated cash requirements. Again, there's no increases or limitations set forth in the Colorado Revised Nonprofit Corporation Act. So anything that's going to be capped or limited is going to be in your declaration. Okay. With that being said, what do your governing documents say? This is a major topic, and the budget approval ratification, as you know, as I hope you all know, that effective July 1st, 2018, every association in the state of Colorado was required to use the budget ratification system as set forth in the Colorado Common Interest Ownership Act. If you're pre-CCIOA, if you have a community formed prior to July 1st, 1992, your declaration may, this is a may, contain something along the lines of the association shall assess on a monthly basis its anticipated cash requirements for that month and impose that assessment upon your owners. That is strictly read, that is a monthly assessment that you were technically supposed to look at your monthly expenditures and assess based on your next upcoming month. I don't think anybody does that is so not prudent to sit there and go on a month-to-month basis. So everybody, and I do say just about everybody in the communities, has turned it into annual budgets. So what do you do with your annual budget? Well, your annual budget, you put together a budget for the upcoming year to meet your anticipated cash requirements. You divide it by 12. That's going to be your monthly budget for an association, and then you allocate that to the individual owners. However, you are required now, every association in the state of Colorado is required to send that budget out within 90 days after the board adopts it and schedule a budget ratification meeting. At the budget ratification meeting, it's deemed to be approved unless a majority of all owners in the community veto it. All right, so we understand that concept. What if you have a specific cap in your budget or in your declaration? Something along the lines of the maximum annual assessment shall be $100 per month, as may be adjusted pursuant to the consumer price index for the Denver Boulder area, and then you go year by year and you look at that. And that's how much your maximum annual assessment may increase on an annual basis. If you have a declaration that contains a maximum annual assessment or an assessment cap, assessments cannot be increased year over year by more than 10%. You still have to adopt a budget as a board. You still have to send the budget out to the owners. And you still must schedule a meeting with the owners to discuss the budget. Now, if your documents contain a cap, you don't have to have a vote. That was carved out of the statute. So if you do have one of those documents that contain assessment caps, you still have to have a meeting to discuss the budget. You just don't actually take a ratification vote. That is deemed to be approved when the board adopts it. The only time you need a vote is if you're planning on going above the assessment cap. What do you do with mid-year increases? Let's say you do have an unexpected expenditure. How can you do a mid-year increase? Well, according to CCIOA, you adopt a budget, you send it out to the owners for the rest of the year, and it's deemed approved unless vetoed by a majority of all the owners. You could actually do mid-year increases in a CCIOA community. You just adopt a new budget, you send it out, you go through the exact same process. All right, so what are the pros and cons of trying to solve all your financial concerns using just your annual assessment? Well, one of the pros is the owners get a full year to pay for it. They can take that increase in assessment, they get 12 months to pay for it, and hopefully that 12 months won't be too much of a financial strain on them, that you can actually have the assessment do what you need it to do. You can meet your budgets. Plus, if you are regularly increasing your assessments, and if you are keeping up with expenses, and if you are keeping up with your requirements of your reserve study, there won't be quote unquote sticker shock when you raise assessments, because every year the owners are going to expect, or every other year the owners are going to expect a 3 to 5% increase. They can budget for it. They understand it's coming, and they can move forward with it. The cons are obviously you don't get the money right away. You have to wait. You have to wait 12 months, and if an owner falls delinquent, they get a 6-month payment plan. So any projects that you were trying to do with using just assessments, common expense assessments on an annual basis, they're going to have to wait until the following year because you have to build up those reserves, which gets to the reserves. You have to build up those components so you can make sure you can pay for it. That is the biggest con doing it this way. It is you are always a year in arrears on your project. It requires planning, it requires budgeting, and it requires discipline to make sure that you are moving forward as needed. All right, I do have a question that says, so you're saying that a pre-CCIOA community doesn't have to ratify the budget if they don't go above the assessment cap but still have to hold the meeting? The answer is yes, you do. The statute mandates the board adopt a budget, send it out to the owners, schedule a meeting to discuss it, but there's no vote requirement if it is a pre-CCIOA community with an assessment cap. Very specific concept. Pre-CCIOA, assessment cap, you still have to do all the steps, but there's no budget ratification meeting. So we have the pros and cons of trying to use just your budget. We have the pros and cons of trying to address it that way. Oh, another con, quite frankly, is if you're trying to catch up with assessments. If you are trying to catch up with deferred maintenance using just your annual assessments, your assessments are going to increase and they're going to stay high. And you may not, as an association, be competitive in the market when your assessments are on their face 2 to 3 times what other associations may be charging, because you're playing catch up. And you've got a lot of money coming in that's going to cure past sins, if you will, that since you have to, you're running after, you're chasing your tail a little bit, your assessments are going to be higher than your competitors. If your competitors were disciplined, if your competitors raised assessments, and you are a nonprofit corporation and you are competing for business and you need to make your units marketable. That is the ultimate goal, is to make the units marketable, to increase property values, to maintain the community. And if you're not raising assessments, you could be failing on that concept because, again, you're falling behind. Okay, before I leave the slide, I'll answer one more question. There. Wait. All right, we're good. So, moving forward. Special assessments. Well, what does CCIOA say? I don't know if you would be surprised to understand that the word special assessment only appears in CCIOA twice, and it's not where you think it would be. CCIOA only treats assessments. All assessments are, all dues, structures, or money due to the association are considered to be assessments. Whether it be a special assessment, part of the annual assessment, I've understood a popular term arising of a loss assessment or to trigger some sort of insurance payment. None of those terms are defined in CCIOA. The only thing that's defined in CCIOA is common expense assessment, which equals an individual owner's allocation of the expenses of the association. So what does CCIOA say about special assessments? It doesn't. What I believe it says is that any budget you adopt, whether it be a special assessment, whether it be an annual assessment, must be treated the same. You must go through the budget process set forth in your governing documents. So if your governing documents say the association may adopt a special assessment to cover unanticipated costs and expenses or unanticipated maintenance upon the approval of 2/3% of its owners, that's how you treat that special assessment. If your documents are silent on special assessments, you go through the budget ratification process. And that's really what a lot of pre-CCIOA communities did. There's a lot of pre-CCIOA communities, again, that you could impose a special assessment upon the owners or impose an assessment upon the owners. It is the same with imposing a special assessment. The only trick now is that you must go through the budget ratification process set forth in section 303.4 of CCIOA, or 303 sub 4 of CCIOA. Board adopts the budget, sends it to the owners. Within 90 days, you must have a meeting. Okay. But getting back to what do your governing documents say? Again, we talked about it. Do you have an affirmative approval requirement for a special assessment? If you do, you must go through that process. If you don't, you go through the veto process. Another popular declaration provision that was in a lot of documents that kind of popped up is, again, if you have an insurance shortfall, that you can just assess an insurance shortfall to your owners without having to go through the budget process. With the changes in CCIOA, I don't think that is appropriate anymore. I believe you have to go through the budget approval process because, again, CCIOA does not, on its face, distinguish special assessments, regular assessments, annual assessments, loss assessments, any of those terms. They're all just common expense assessments, which must go through the budget approval process. Do you have specific caps for special assessments, such as the association may raise up to $25,000 without a vote? Again, what does it say? You've got to look at your documents. Allocation of assessments. This has become a big issue as well. How do you allocate your assessments in a special assessment context? Does your budget or do your declarations allow for the assessment to individual owners for certain expenses? Extraordinary maintenance, a number of decks that don't have to be repaired on the community as a whole, but it's just western-facing decks because of the additional exposure to sun. Can that be assessed just to them? What happens if you have a hailstorm and let's say only half the buildings are impacted somehow, magically? Only half the buildings are done. Can you allocate the cost of the assessment just to those individual owners benefiting from the same? It's a good question. And I see I've got a question popped up. I'll change to it in just a second before I leave the slide. But we'll go over some of the pros and cons of special assessments. One of the big pros is you get your money right away. Special assessments are usually payable within 30 days. It's also a one-time shot in the arm. You don't have to worry about this ongoing assessment. You don't have to worry about once it's paid, it's gone. Once it's paid, the association can catch up on its finances and it's outside of the normal income stream. So therefore you have it, it's gone. You have it, you assess it, it's paid, it's gone. Some of the cons associated with special assessments is it can be a financial hit on the owners. If you go to your owners and say, we need $5,000 in the next 30 days, how many can pay? You need $5,000 extra this year, how many can pay? It also, an association that gets a reputation with the number of special assessments, again, may impact property values because the appearance would be that you're not budgeting correctly. Another big drawback on large special assessments is, let's say you special assess $10,000 and an owner goes into foreclosure. Some banks push back on including that special assessment in the super lien, particularly if you allow for payment of a special assessment over 12 months. Let's say it's a $10,000 or $12,000 special assessment, because I like easy math. You assess $12,000, you allow it to be paid over 6 months. Come month 7, the owner goes into foreclosure. Well, all of a sudden, even if you could include that special assessment in the super lien, you are now outside of it, and those additional payments of $1,000 for $5,000 some dollars or $5,000 remaining may not be collectible as part of the special assessment through the super lien. So you're at risk of losing a portion of your special assessment due to foreclosures. The larger the special assessment, the more the banks push back. And we've had success on some hands, including it in the super lien, not on others. And it really does depend on how the association handled it, how it was assessed, and how it was addressed. Okay. Okay, and one of the questions is, pre-CCIOA with a cap, can the earlier cap roll over each year if the assessments are not increased? Boy, that's a really good question. And generally speaking, Again, I've had success both ways depending on who's asking and how it was done. We use the term recapture. And let's say you're special. Let's say you have been plugging along at raising assessments 1%. And again, just using the 1%, but you are allowed 3% per year. So instead of being at maximum annual assessment plus X, you're at maximum annual assessment plus Y. And let's say there's maybe a $15,000 difference between the two, which is possible. I've seen it happen. Can you recapture that money? Or can you recapture that? Let's say it's a $20 a month difference between X and Y. Can you recapture that assessment increase? Depending on how you did it and depending on the exact language, yeah, I think you can. I think you can go recapture it. Because most of those provisions were state that the maximum annual assessment shall be $100 plus the annual assessment, right? Or the maximum annual assessment shall be the annual assessment plus the increase in CPI. That gives you one number. If you're at a different number, it didn't say it was a year-over-year increase. It said this was the maximum annual assessment. So this is what your assessment could be. I think, yes, you can recapture it. But if you have the maximum annual assessment shall be 10% year-over-year, then no, you can't. Because that is based on a year-over-year increase. But if it's based on the CPI or if it's based on a 5% increase per year and you never take it, that is not tied to the previous year, yeah, I think you can recapture and make up some of those shortfalls because quite frankly, again, if you don't and you do have a cap, you're never going to catch up. At this point, I've seen some caps that have not even kept pace with insurance and water costs. Forget the maintenance piece, forget the management piece, it did not even pay for the increased insurance and in water. Another question, if the HOA has an assessment increase cap and the board goes beyond the cap in the proposed budget, what is the process? If it's less than 51% of the members do not veto, then the budget is ratified. It is whatever your documents say it is. If it states that the maximum annual assessment is, or if it says the assessment cannot be increased year over year by more than 10% without the 2/3 vote of the owners, then it cannot go over 2/3%, 10% without 2/3 vote. The statute does not change those caps. It just says if you have a cap and you're not increasing beyond it, you don't have to have the ratification vote. You still have to have the meeting. You don't have to have the vote. In your particular case, if the HOA has an assessment increase and the board goes beyond the cap in the proposed budget, what is the process? You need a vote. You need to go through whatever your declaration says is the voting requirement. And it's unfortunate. And like I said, in many situations, you may not be able to catch up without a vote, or if you've got a whole lot of people that just don't care, it makes it very difficult. Okay. All right, additional considerations. Like I said, you've got to be prudent. You have to make prudent, informed decisions. You have to look at all the options available. You really need to communicate like nobody's business as to why things are happening, what's happening, what you're doing. Know your numbers ahead of time. Make sure that you're not throwing estimates out. I know an association that came down and said, one expert came in and said, oh, you need a special assessment in this amount. And the association at that time had a fiduciary duty to start informing owners of, we know what the deferred maintenance costs are. We have a bid of X amount, and therefore you need to start disclosing it when you sell that there is a potential special assessment in the amount of X. Well, that number was exaggerated by about 100%. It was for one scope of work, and the association was able to trim that scope of work down. So there was a period of time where there was undue anxiety and undue hardship in the community because the board went out with an inaccurate number. But make sure you get your numbers, make sure you get them ahead of time, and make sure you're right. The other thing that you really need to do too is you need to know the assessment capability of your owners. You don't want to get into a situation, and this is where it's so critical to some managers and so critical for some communities, that you understand what the assessment capabilities are of your community, because you can't go into a situation where you are cruising right along at $200 a month for 7 years, and then all of a sudden your real assessment requirement's $600. Your community may not be able to absorb that. You may need to put into place a plan where you gradually raise assessments. Go from 200 to 220, 220 to 240, 240 to 260, 260 to 280. It is, you can't just price your owners out of their own community, but at the same time, you do have an obligation to make sure that what you are budgeting is a real number, plus reserves. The breach of fiduciary duty claims come up when all of a sudden you start raising assessments like nobody's business. I discussed with the manager the other day that their assessment increase is going to be north of 50%. And if you're all of a sudden going north of 50% in a community that has a lot of deferred maintenance, in a community that, quite frankly, many people may be struggling to keep up with the existing, you're going to start pushing people out of the community, or you're going to increase your default rate. And if you increase your default rate, that becomes an additional undue burden on your other remaining owners. So it's kind of this concept of your taxing authority is, if you're taxing at $200 and you've got everybody paying that, if you go to 210, you still get everybody paying it. But if you go to 250 and 10% of the population drops off, then all of a sudden your net income to the association, given the amount of people that could not make that additional jump to 250, your net income to the association may actually fall. And it's this concept of, you got to find that sweet spot. You got to find that right number that is both palatable to your owners while meeting your expenses. And that's why it is so critical that you increase assessments on an annual basis. Nothing makes me cringe more when I hear we've been able to keep assessments flat for 5 years in a row, because the cost of living has not stopped for 5 years in a row. Okay. Use your experts. Use your reserve study people. Use your insurance experts. Use your attorneys. Make sure that if it's a insurance issue, that you bring your insurance brokers in so they can talk about what type of insurance policy the owners need to get. Maybe who some of the better carriers are. It may take that somebody has to go change insurance companies to get the right coverage, because you want to make sure that the individual owners are, to the extent humanly possible, covered for all contingencies. It's not your obligation. It's not the association's fight to have, but it is the association's obligation to provide information. It is the association's obligation to make sure that each individual has as much knowledge and experience as possible to go out and acquire the right product. This is why in the Colorado Common Interest Ownership Act, there is a mandatory homeowner education at annually. You need to make sure you're educating your owners what the association's insurance policy is, what their policy is, what their policy needs to cover, the limits of the association's master policy. I know that many associations are going to a $25,000 deductible just for water leaks. And this is because, forgive the pun, they want to dry up the interior water leaks. They're killing association policies. They're killing associations. So you need to make sure you're communicating to your owners that, dear owners, the first $25,000 of any loss is on you. You need to go get the right policy. You need to make sure you're prepared. You need to take control of this. Make sure that you're providing the education. It does really matter. Make sure you're communicating with your owners. Lots of communication, websites, emails, constant contact. And then, like I said, the board needs to be prudent in its informed decision. It needs to make sure it understands its community, understands the situation and what's going on. Of course, let's talk about loans. As a disclosure, I'm a big proponent of a loan. I think they are a wonderful tool for an association to be able to get over the hump if they have been ineffectively reserving over the course of years. The purpose of a loan is twofold. One, it's to help the association pay for a large-scale capital project that they may not have sufficient funds for. It is a wonderful tool to use that you don't drain your reserve account while you have the ability to go borrow the funds. Interest rates are great. You can keep your money for future uses while you are paying the loan off. Another big pro of a loan is, since that it's an association loan, it's not attached to any individual owner. It is paid for over 10 years. If an owner decides to move 2 years into a project or 2 years after a roof is replaced, they're only paying for that short period of time that they lived in the community, handing off the baton to their buyer to come pay for the rest of the roof. It is a wonderful tool to enable associations to get over that hump. Plus, it allows associations, like I said, to pay for some of these big projects over 10 years. And as you're paying for them over a number of years, the budget hit's not that much. Even with the, we talked about special assessments. Well, that's a 6-month, it's a 6-month commitment, or a annual assessment increase that doubles assessments, that you are no longer competitive in the market. A loan can be spread out over 10 to 15 years, allowing owners to pass that obligation on to their sellers, and it allows the association to catch up. It allows the association to keep its assessments at least at a manageable level. Obviously, one of the biggest cons of a loan is it's a line item on your budget that you must meet for the next 10 years. And when year 10 comes around, you may look back and say, what did we get for those loan amounts? Because your ownership has changed over. When owners come in, they say, what is this loan paying for? And may go take some looking to find out what exactly you used that loan for. It is an ongoing obligation. I know a lot of attorneys and a lot of managers don't like loans for that very reason. They'd like to just rip the Band-Aid off, get the special assessment done, and get it paid for. Another issue that you have with loans is owners may want to pay for them in advance. And it's very difficult to go to an owner and say, okay, dear owner, we have this line item on our budget that's for debt service. And this debt service is this amount, and it's attributable to your unit. And we understand that you may not want to pay it, so you want to pay it up front so you can save that 4.5% interest. That's great. We can take the money, we can reduce the loan amount. Problem is, some of the loans will contain lockout provisions where you can't prepay once the loan is funded. Another problem you have is the accounting piece. If I come up and I say I want to pay this loan in advance, and it's my unit is no longer part of this debt, well, that's not really true. Because if you have an owner that defaults, or an owner otherwise that gets foreclosed out, whatever that owner did not pay on that loan, whatever amount is lost in the assessment, that is going to go to the association to pay out of general debt service. So even though I paid my $10,000 and saved my interest, to the extent that there's any loan shortfall or anybody that defaults and there's a shortfall in the debt service, that's going to go back to all the other owners. Now, is it a small amount? Yes. Is it spread out amongst all the owners? Yes. But you cannot hard and fast say, once I pay, I'm done. That is not necessarily a true statement, and you need to be able to educate your owners as to that concept. Got a question, is it appropriate to special assess to pay for a loan? Well, a lot of lenders will want you to special assess to pay for the loan. I disagree with that concept. I understand what they're trying to do is they're trying to get the debt, they're trying to get your assessment level up to a certain amount so that you can pay for it. The problem you have with special assessing to pay for a loan is, like I said, a loan is payable over 10 years. A special assessment is payable over 6 months, maybe a year. If it's payable any longer than 12 months, and your declaration may state it's maybe assessed in that year only, if it is assessed any longer, it becomes part of your common expense assessments. It's not a special assessment. So a debt service should be part of the regular assessment. It should be part of the common expense assessments allocated to the annual budget. What I've seen a lot of associations do is they special assess while they have a loan to increase their reserve component, and to cover those pieces of the community that may fall to debt service during the first year, and then they roll it into their annual budget for the debt service. So it's a nuance that you really should not be special assessing to pay for the loan. You should be special assessing to get your assessment income to a certain amount to service the debt while not falling behind on matters in the community. And then the next year rolling into it, that should be a common expense assessment. Plus also remember what I talked about special assessments is you may lose that in a foreclosure. So if you are sitting here in special assessing and you don't get to include that in the super lien payment, you just lost up to 6 months of debt service that otherwise would have had if you'd have just thrown it into the common expense assessments. So I think special assessing for a loan is a bad idea. Special assessment while you have a loan is not necessarily a bad idea. Just don't say it's going to the loan. It should be going to common expense assessments to the association that are otherwise being paid for by debt. Okay. How do you get a loan? Well, you have to have specific authority in your declaration if you are a CCIOA community. Post-CCIOA communities state you can obtain a loan and pledge your right to pledge your right to receive future income to the extent expressly provided in the declaration. Now, I have seen problems with those concepts. One problem is that when developers write their documents, they tend to just cut and paste stuff straight out of the Colorado Common Interest Ownership Act, particularly when they're talking about purposes and powers. Now, this comes out of Section 302 of the Colorado Common Interest Ownership Act, the purposes and powers of an association. And if the developer merely cuts and pastes, throws that in there, what gets in the declaration? What gets in the declaration is the association may borrow and pledge its right to receive future income to the extent expressly provided in the declaration. Well, it doesn't expressly provide, it just regurgitates what's in the statute. That is not sufficient authority. Also, not sufficient authority is if your bylaws state the association may borrow and pledge its right to future income as a power of the nonprofit corporation. It's in the wrong document. It must be in your declaration. So if your declaration is either silent or if your declaration is contains language straight out of the statute, really what you need to do is it requires whatever it takes to amend that declaration, that's what it takes to borrow, because you are going to have to get approval to essentially amend the declaration to allow the association to borrow and pledge its right to future income, and you put it in the declaration. It becomes an amendment to the declaration. Many associations will just put in their declaration, if they amend and restate, that they have the right to borrow and pledge the right to receive future income upon the vote of a majority of a quorum at a meeting in which a quorum is present. Then all of a sudden that becomes a regular vote. You still have owner's permission requirement, but it's not something that can't be overcome. In pre-CCIOA, is there an absolute stated prohibition? That is the only thing that would be there and this could be in any of your governing documents. It could be in your articles, your bylaws, your declaration that says the association does not have the right to borrow. Most pre-CCIOA communities, the concept of pledging your right to receive future income was foreign to the developer when they created those documents. So usually it doesn't state whether or not the association can pledge its right to receive future income. So if you're a pre-CCIOA community, you can rely on the power in the Nonprofit Act. And the Nonprofit Act says specifically, a nonprofit corporation shall have the right to pledge its right to receive future income and enter into indebtedness. So it's a little bit easier if you are in a pre-CCIOA community than a post-CCIOA community. Like I said, in post-CCIOA communities, you have to have express authority. Okay, so do whatever that says. We've talked about the purpose of the loan, talked about the pros and the cons, some of the abilities. And I will answer the question. And the next question I have is, there are difficulties in obtaining loans when the association does not qualify for the amount that is needed for big projects. Yeah, that is a problem. And the cost of interest is greatly increasing the cost of the needed project. For many communities, they don't have the ability to borrow enough to cover the needed project. And yes, it is, and it's tough. So again, this gets back to, it's not really a question as opposed to a statement, but I think the response to this is, yeah, in associations in that dire need, they need to find a way to budget. They need to find a way to, again, increase assessments. They need to find a way to get to that platform where they do become bankable and they can acquire a loan, because short of that, it's either that or special assessments or parts of their annual budget. And it becomes really problematic. It is almost to the extent of a downward spiral, in that the more you raise assessments, the more defaults you get, the more defaults you get, the more you need to raise assessments. And like I said, you've got to find that sweet spot of where you maximize your benefit, and then you're just going to have to prioritize. And I've recommended to associations that had deck problems, for example, they couldn't afford to repair the decks and they had become unsafe. They shut them off. They taped them off and they said, you cannot use your deck. I've had associations close their pools for extended periods of time because they did not have the budget to open them. They did not have the ability to do the repairs necessary. And does that impact the community? Absolutely impacts the community. But it's a place to save money while you start to find your way out of these processes. And one of the things that, I think is lost sometimes is every association is a small nonprofit closely held corporation. That's what they are. I mean, they're communities and they're a group of homes, but as far as the business piece, they are small nonprofit corporations. They really should have a business plan. They should have a business plan that addresses how they are going to assess how they're going to raise money. When they raise money, where are they going to spend it? What is again, you create budgets, but you've got to also create a plan to increase property values, a plan to increase X. And you need to make sure that you adhere to that plan moving forward. You have to make sure that while you are budgeting, you have purposes and goals. You're not being reactive. You should plan for this. You should have a strategic plan in place as to where the community is now and where the community wants to be. How do you increase those property values to get there? How do you increase turnover? Do you have a working capital fund? If you have a working capital payment that it happens at the sale of each unit, is it enough? Can you increase it? It would require an amendment to the declaration, but if you have lost the ability at every sale to collect 2 months common expense assessments or 3 months common expense assessments, why? Why not go back, amend the declaration, and say every owner buying into this community is going to pay 3 months working capital to the association that goes into its reserve account to help pay for the costs moving forward. Again, I think it's defensible because it's going to prepay things that the owner or the new buyer in the community is going to receive the benefit of. And then all of a sudden, if you have 10% turnover on at least 10% of the units, you are getting 15 months common expense assessments in the first 12 months of ownership. It really is a quick way to start to increase your reserve accounts. But it gets back to the bottom line, do what your documents say. And with all that being said, you have to stay on for 2 more minutes if you want credits. I will answer any more questions, or I will just sit here and talk for 2 more minutes. Don't go away. So anyway, we've had a good time. It's been enjoyable. And it's like I said, everybody, just make sure you know what your documents say. Make sure you know what the declaration says. Make sure you know what your bylaws say. And make sure that there are sometimes hidden places that you have these prohibitions. And that's actually a really good place to leave the community. I can carry on for another minute on, was reviewing loan documents once, and there was nothing in the governing documents. There was nothing in the declaration that said they could not borrow. This was a pre-CCIOA community. So I was going on my merry way, having a good time with it. And then it came up that it was actually in the in the bylaw, the articles that said they could not borrow. And it threw me for a loop. So you need to make sure, again, that when you are looking at this stuff, you look at all the documents. And yes, it's another thing popped up. Perhaps do a smaller loan, try and phase it in. Those are great things. We've had a community do a 2-phase loan. They got one loan, they paid it down a little bit, and then refinanced it a little bit later with the same bank. Again, increasing the amount, but they were able to service that debt, put that money initially to work, and then got another $1 million to do other projects. So there's a way to talk to your banker and really try and handle that. And with that, thank you so much, everybody. You get your credits. I'm so proud of us. Have a great day. And I will stick around for another couple minutes. If you want to type any questions, I'll answer them. Okay, we have found several contractors willing to carry the cost. That's another great idea too. If you can get unsecured debt, essentially may cost you a little bit more, but if the contractor is willing to carry the paper, particularly in a post-CCIOA community, since you're not pledging your right to future assessments, you can usually borrow. It's that pledging your right to future assessments that's the problem. And again, thank you so much, everybody. You have a wonderful day. Registration should have been at the very beginning. If you did, go ahead and reach out to education@altitude.law, or you can call Sean directly at 303-991-2076. He'll take care of you. All right. Hey, thanks, everybody. It's been great. I'll go ahead and log off now.